On Monday, Scott Bessant told the world to buy U.S. assets. By Tuesday, $15 billion had vanished into gold. And by Friday, the dollar had cratered 9%, its worst fall since 2008. So ask yourself, why is America begging for investment? While its own investors are running for the exits, Apple's eating a $900 million tariff bill. The Treasury's borrowing $500 billion just to stay afloat. And behind the curtain, the trade talks with China don't exist. This isn't a strategy. This is triage. And it just went global. On May 6, 2025, Treasury Secretary Scott Bessant stood before global CEOs at the Milken Institute and delivered what sounded less like policy and more like performance. We've uprooted waste-planted investment and fertilized growth. But behind the metaphor was a crisis pitch. With the US dollar down 9.2% since April 2nd. According to Bloomberg, and foreign investors offloading $36 billion in treasuries. In just 2 weeks, the U.S. wasn't offering opportunity. It was begging for stabilization. The Financial Times reported that Japan and Germany both halted new bond purchases, citing currency volatility and tariff uncertainty. And yet Besant insisted that America is the Schelling point of global finance, a phrase that in game theory implies mutual convergence. But if mutual trust is the foundation, is it still intact when America is hemorrhaging capital, not attracting it? But the real question, was this about optimism, or was it damage control before the next wave hits? The Wall Street Journal reported that the dollar's 9% decline since the April tariff hike is wiping out gains for foreign investors, even as U.S. equities attempt to rebound with the S&P 500 up just 1.7% year-to-date, less than the inflation rate. Foreign buyers face a math problem. Treasury yields near 4.9% don't compensate for currency loss, especially with U.S. CPI still above 3.2% and energy prices rising 11.4% since March. According to HSBC's Q2 investor briefing, institutional clients are shifting dollar-denominated allocations into Eurozone and Swiss franc assets. Meanwhile, Besant's assertion that deep capital markets offer security ignores that liquidity without confidence can accelerate exits, not prevent them. And that exit already started net outflows from U.S. equities totaled $11.6 billion in April per Bank of America. So when the pitch relies on dominance, and that dominance is in retreat, is the appeal still real or just rhetorical scaffolding? And if the scaffolding collapses, what exactly is left holding up the house? In the week ending May 3rd, the Nasdaq recorded its highest volatility index spike since October 2022. Yet Besant described U.S. markets as anti-fragile. That claim stands in sharp contrast to Goldman Sachs' latest note warning of valuation headwinds and forecasting just a 3% upside for U.S. equities through Q4 2025. The Conference Board's Consumer Confidence Index dropped to 95, to the lowest since June 2020, while McDonald's reported a 6.4% decline in U.S. same-store sales, its worst quarter since the pandemic. Meanwhile, the Atlanta Fed's GDP, now tracker, revised Q2 growth to just 0.6% after Q1 came in flat. In that environment, Besant's up and to the right mantra sounds less like economic insight and more like mythology. And when mythology meets quarterly earnings season, the disconnect becomes impossible to ignore. But what if this isn't optimism? It's insulation against admitting what happens when spending slows and borrowing spikes. Let's stop for a moment. Because when Warren Buffett's "Never Bet Against America" line gets pulled into a Treasury speech, it's rarely a sign of strength. In reality, even Buffett trimmed U.S. exposure in the first quarter. according to SEC filings, slashing his stake in U.S. financials by 12%. Janet Yellen's warning, issued May 4th, via the Brookings Institution, was unambiguous. These tariffs could move us 40% closer to recession if critical inputs remain disrupted. Her point wasn't speculative. U.S. clean energy firms like Plug Power and Albemarle have already cut production forecasts due to blocked Chinese mineral imports. In parallel, Bloomberg data shows first quarter capital expenditures across S&P 500 firms dropped 9.8%, the steepest quarterly decline since 2009. And yet Besant's narrative is built on growth through deregulation, tax cuts, and liquidity. But when capital expenditure shrinks, consumption softens, and the Treasury is borrowing $514 billion in a single quarter, what's really being pitched here? Because if this is the start of a harvest, where exactly is the yield? On May 3, 2025, gold prices surged by 13% in under 60 seconds, equivalent to over $280 per ounce, signaling not just inflation hedging, but outright loss of confidence in fiat stability. According to Bloomberg, this sudden spike was fueled by institutional orders totaling more than $15 billion triggered by automated sell-offs in U.S. Treasuries and ETF reallocations. The World Gold Council reports that central bank purchases hit a quarterly record of 290 metric tons, with China and India leading the buying spree. Meanwhile, the S&P 500 is trading at a forward PE of 21.4, above the 10-year average, while real returns on 10-year treasuries remain negative after adjusting for CPI. This isn't just about safe haven flows. It's about capital seeking an escape route from a system that looks increasingly over-leveraged. As Besant calls for renewed investor confidence, the market is placing its trust in metal, not monetary policy. But the real warning isn't gold's rise. It's what that capital is silently abandoning. Tariffs on Chinese goods now average 135%, with a 20% fentanyl-specific surcharge still in effect. And on May 2nd, the White House formally ended the de minimis rule subjecting all imports under $800 to full taxation. The Port of Long Beach reported that import volume fell 19.2% year over year in April, while delivery costs for Chinese goods have ballooned one container ship alone. The OCL Violet faced $420 million in added tariffs on a $560 million cargo. Apple CFO Luca Maestri confirmed during a May 1st earnings call that the company expects a $900 million increase in tariff-related costs this quarter. For domestic businesses, absorbing or passing on these costs is no longer sustainable. Importers of solar panels, industrial chemicals, and electronics are reporting 30–40% margin compressions, according to a report from the U.S. Chamber of Commerce. So while Besant reassures global investors with talk of long-term resilience, companies on the ground are being choked by a policy framework with no operational clarity. And if even America's largest multinationals can't withstand these costs, who exactly is supposed to carry this economy forward? The latest GDP data released by the Bureau of Economic Analysis shows first quarter 2025 growth flatlining at 0.3%, with imports collapsing 1%, the steepest drop since early 2020, indicating front-loaded consumer demand and disrupted supply chains. Janet Yellen warned in a May 4th Brookings speech that current tariffs are pushing the U.S. 40% closer to a technical recession, especially as over 38% of U.S. industrial inputs are still sourced from China. EV battery manufacturers, including Rivian and General Motors, are already reporting delays in lithium and cobalt supplies, while Plug Power slashed its 2025 revenue forecast by 18% due to raw material constraints. Besant's response to regulation reshoring and tax cuts is financially expansive yet structurally contradictory, with the Treasury on track to borrow $514 billion this quarter and interest payments projected to surpass $1 trillion by year-end. As per the Congressional Budget Office, fiscal leeway is evaporating. Meanwhile, consumer confidence continues to slide now at 95.2% according to the Conference Board. So, what happens when the administration's most aggressive economic lever becomes the very trigger of its slowdown? On May 5th, the U.S. Treasury auctioned $102 billion in 3- and 10-year notes, but only after raising yields by 38 basis points to attract bids, a signal that global appetite is weakening. Foreign holdings of U.S. debt dropped by $71 billion in April, according to the Treasury International Capital TIC report, with China reducing exposure by $23 billion alone. Meanwhile, real yields remain negative across most maturities, and the Federal Reserve has offered no guidance on rate cuts for 2025, citing tariff-driven inflation pressures. The IMF warned last week that the U.S. could face a debt refinancing shock if short-term borrowing continues at this pace, especially with $106 trillion in T-bills maturing before the third quarter. While Besant frames U.S. bonds as a stabilizing anchor, the surge in debt issuance amid policy instability is creating a volatile feedback loop. The capital isn't fleeing just because of yield. It's questioning whether the foundational math still works. And when safety becomes relative, the only question left is safe compared to what? As of May 6, there are no confirmed trade talks with China, despite Besant's suggestion that progress is being made. According to Reuters, the only meeting scheduled in Switzerland is a multilateral session at the World Trade Organization, not a bilateral U.S.-China negotiation. Meanwhile, tariffs have essentially created an economic embargo, with Chinese exports to the U.S. down 31% year over year, and U.S. firms reporting inventory gaps expected to hit shelves by late June. Besant's claim that the surplus country always has more to lose may not hold up against new trade alignments forming across Asia. Vietnam, Malaysia, and India have all increased export volumes to China by over 20% since March. According to regional trade data compiled by Nikkei, the bigger threat may be the fragmentation of global supply chains where the U.S. is no longer the primary node, and if the Swiss talks stall or fail to materialize, the cascading uncertainty will move from policy risk to real-world scarcity. So the real question isn't whether China blinks, it's whether America has anything left to leverage if it doesn't. The American pitch is clear, but will the world still buy it? Scott Besant is telling the world to bet on American resilience, but behind the slogans lies an economy weighed down by $36.2 trillion in national debt trade, gridlock, rising import costs, and weakening investor confidence. The pitch is polished, the delivery flawless, but the audience is changing. Global capital is watching the dollar slip. Gold surge and U.S. bond yields spike to retain attention. The question isn't whether America will survive. It's whether its markets can thrive under these conditions. So now it's your move. Do you think global investors will take the bait or walk away? Drop your thoughts in the comments, because if this standoff drags on, we're not just facing a financial panic. We're witnessing a transformation of global capital itself. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.